Hello, and welcome back to Trade with Alicia. Today we're diving into two crucial concepts in options trading: option premiums and strike prices. Understanding these elements is essential for making informed decisions in options trading. Let's explore how they work and why they're so important. Option premiums are the prices you pay to buy an option or receive when you sell one. Strike prices are the predetermined prices at which the underlying asset can be bought or sold if the option is exercised. Let's break these down further. Think of an option premium like a ticket to a concert. The more popular the band, the higher the ticket price. Similarly, option premiums are influenced by various factors. 1. Intrinsic value, how much the option is in the money. 2. Time value, how much time is left until expiration. 3. Volatility, how much the underlying stock price fluctuates. 4. Interest rates. Higher rates typically increase call premiums and decrease put premiums. Now let's talk about strike prices. Imagine a ladder where each rung represents a different strike price. The current stock price is somewhere on this ladder, and prices increase as you climb higher. For call options, think of it this way. Rungs below the current price are in the money. These options already have intrinsic value. Rungs above the current price are out of the money, meaning the stock price needs to climb for these options to have value. For put options, it's the opposite. Rungs above the current price are in the money, while rungs below are out of the money. Let's look at a real example using Apple Inc. stock. Suppose AAPL is trading at $247. We'll look at call options expiring in 32 days. Strike $240 in the money, premium $12.10, strike $245 at the money, premium $870, strike $250 out of the money, premium $615. Notice how the premium decreases as the strike price moves further out of the money. For put options, strike $240 out of the money, premium $390, strike $245 at the money, premium $580, strike $250 in the money, premium $775. As we move from out of the money towards in the money options, we see an increase in both premium and probability of profit. Options further out of the money are cheaper but have a lower chance of being profitable. Conversely, options closer to being in the money or already in the money have higher premiums but also a greater likelihood of expiring with value. This relationship reflects the balance between an option's cost and its potential for profit, with traders paying more for options that have a higher probability of success. Why are premiums and strike prices important? Risk assessment. Higher premiums generally indicate a higher probability of profit, POP, for the option buyer, but also represent a larger initial cost and maximum potential loss. Profit potential. Strike price determines when options become profitable. Strategy selection. Different strikes suit different market outlooks. Break-even calculation. Premium minus strike price for calls. Strike price minus premium for puts. Remember, choosing the right combination of premium and strike price is crucial for successful options trading. To summarize, option premiums and strike prices are fundamental to options trading. They determine the cost, potential profit, and risk of your trades. Understanding how they work and interact is key to developing effective option strategies. And that's it for today. You now have a solid grasp of option premiums and strike prices. If you found this helpful, please like this video and subscribe for more trading insights. Thanks for watching and happy trading.